So tonight's webinar is entitled Replicating Walter Schloss's Investment Technique. And if you're not familiar with the man, Walter Schloss is a fellow Grahamite, I guess you would call him. He was trained by Benjamin Graham, as was Warren Buffett and several others. He's one that Buffett called one of the great super investors. And the interesting thing about Schloss, one, he was very much off the radar. He managed a small amount of money relative to what many of his peers were. He had zero staff except for his son, and he did not do nearly as much in-depth analysis of the companies as many of the great investors did, and simply had a cheap stock pattern, and it worked out very well for him. So I want to kind of explore tonight what he did and how we can kind of mimic some of his techniques. Now, quick disclaimer, obviously all the information presented here is to the best of our knowledge true and accurate. However, if there are typos or data errors, we do apologize for that. Now, this is Walter Schloss. He's getting up there in years. Born in 1916. Started out, did not go to college, has no college degree, got a job as a runner on Wall Street at age 18. And on a tip from a friend, read the security analysis by Ben Graham. Ended up taking one of his night courses. Went off to the Army, and then Graham called him and said, "Hey, I had an analyst leave. Can you come work for me?" So went to work for Ben Graham. Worked there for a couple of years till Graham retired and shut down that partnership. And then Walter had, just through contacts he made there, about 19 people willing to invest with him. Started his own limited partnership in 1955. Now, over the entirety of that, I believe he shut it down around the year 2000, returned 15.3% a year on average for 45 years. Now, his partnership was set up to where he charged no management fees but took 25% of the profit. So, before that profit sharing, he averaged about 20% a year, which is a phenomenal track record for that amount of time. So Schloss, very much an off-the-radar manager, right? Did not get any press whatsoever until about the mid-'80s when Buffett mentioned him in a couple of shareholder letters, kind of as a recommendation, people looking for a place to put money. And again, Buffett mentioned him later in an essay called The Super Investors of Graham and Doddsville. And if you were unsure on the stock market or have someone who believes that it is still sheer luck as to who wins and who loses, I encourage you to read that. It's about a 15-page essay written by Buffett just talking about he and some of his peers who all came from Graham and all went separate ways and have all produced wonderful track records. So this is a look at his track record through 1984. I apologize, a little bit small. I mean, back when he was doing this, reporting requirements were much lighter than they are today, and considering they had a small partnership, he did not have to file 13Fs like many of the large fund managers do today. But as you can see, I mean, you can scroll through this a bit. He did not beat the market each and every year, but over the big picture, he just absolutely annihilated the S&P 500 index and had some huge years where he did so remarkably well. So let's talk about his investment philosophy really quickly, because I want you to kind of understand the broad strokes of this. He bought value, as you can imagine, and diversified adequately, but not excessively, and remained patient. So what does that mean? Well, he literally just looked for cheap stocks. There were value companies where he can get more assets in his investment dollar. He diversified bordering on excessively. I mean, he regularly held 60 to 100 securities in his portfolio. He's extremely patient with those holdings. He rarely talked to management, if ever, and invested only on the numbers. So he and his son would only visit companies that were within like a 10-block radius of their office. Didn't feel they could get anything from management, that they could just pull the wool over his eyes. And instead just stayed off the radar and used only public information, had no big contacts on Wall Street, just looked at value line charts and company filings. So this big focus, this guy, was book value, and so many people today are focused on earnings. We're looking at the PE ratio, we're looking at free cash flows. You got guys like Peter Lynch, who were phenomenal investors who were mostly focused on earnings. But Schloss took the other side of this. He looked just at book, just at assets, as long as they weren't bleeding cash out. But he was famous for saying, asset values fluctuate more slowly than earnings do. And in all the interviews and all the things I've read of him, he was very strong on the fact that he just can't predict earnings. That I don't know if they're going to come in at $1.25 or $5 or negative $2. So instead of trying to predict that, which is very difficult to do even in today's market, especially people that try to do it quarter over quarter, he just focused on the assets there and tried to pick up bargains where he could. So his primary focus, looking at low price to book ratios. He wants to buy the company preferably at a discount to book, if not then very close to it. So when he did look at earnings, he liked low prices compared to what he called normalized earnings. Okay, so instead of basing it off of what analysts think they're going to do next year, what they did the very last 12 months, he's not looking at growth. He's looking at slower, more stable businesses, steel companies and the like, and he'll average out their earnings for the last 3 to 5 years or 10 years. Say, okay, they're usually good for about 50 million a year, 100 million a year, whatever that is, because his longer term outlook allowed him to have that bigger picture view. Correct. Yeah, I mean, preferably book value greater than what it's currently trading at. So a price to book ratio below 1. Now, his preference, like most of these value guys, he likes stocks with long histories and track records, okay, 15 to 20 years. So a lot of the stuff on Schloss, like he's a boring investor by most standards, but boring just slaughtered the market. And I'll show you, I mean, you can see the numbers, like $10,000 with him over 50 years turned into, 20 million or whatever it is. I mean, just slow and steadily, boringly beating the market year over year worked very well for him. So he maintained kind of a diversified, cheap basket of stocks, and that was really his strategy for risk. And he even commented on the times that Buffett would say, diversification is something basically something to the effect of you only need to diversify if you don't know what you're doing. And Schloss regularly said, "Yeah, that's right, but we're not as I don't think I'm as good as Buffett at predicting these things. So, where I may buy one cheap book for a reason and end up going bankrupt, well, it's one of 100 stocks I own, and it's not going to destroy my portfolio." So he bought enough of these cheap stocks that being wrong a few times wasn't going to destroy his track record and destroy the returns. And as I mentioned, often owned 60 to 100 stocks, sometimes more than 100 at any given time. His max concentration to one stock was about 10% of that partnership. So he, like any of us, I mean, liked some of the picks better than others. He really liked it. He built into a position, but up to about 10% in any one stock, which is significant if you've got a 100 security portfolio, right? I mean, you're putting 10 times what the average number of your stocks is, but 10% kind of where he maxed out. And his average holding period was 4 years. We had roughly 25% annual turnover, and over a 50-year period, you've got enough data to see that most of his stocks were held for about a 4-year period, which should give you kind of an idea of how long this takes for some of these low price to books to be recognized and realized or turn their situation around. So these are kind of his buying guidelines, and how he got in and out of securities. He preferred to buy at half to 2/3 of book value. Okay, now he never specified tangible book, so I'm thinking he did probably like a lot of us did. He took book for what it was. You got to remember when he was investing, there weren't as large of these intangible items on the balance sheet. So like any of us, he's going to discount some of that out, but he didn't use hard rules of saying any intangibles are completely wiped off, because there are companies, there are the Coca-Colas and whatnot that pay more than book value for a company that puts goodwill or intangible assets on their balance sheet that are actually worthwhile. Okay, so if you guys are unfamiliar with this, just so you know, when you see goodwill on a balance sheet, sometimes it's garbage, sometimes it's not, right? So if I went and bought Coca-Cola today, the whole thing, I'm a trillionaire, I'll go buy Coca-Cola, right? I don't know what their market cap is, 100 billion, something like that, 50 billion, whatever it is. If I buy Coca-Cola for $100 billion, but their book value is only 50 billion, do you think Coke's worth 100? Or do you think it's worth 50? I mean, they've got tremendous earning power. They've got trademarks. They've got this whole distribution channel and all this. I mean, they're worth more than book value. So that difference will be carried on my balance sheet as goodwill. So in some cases, just because it's intangible does not mean it's worthless. But other companies hold large intangibles that really are kind of worthless. So just throwing that out there. But he preferred half to 2/3 book value. and would pay up to book or up to a little bit over book value for a strong company. And he commented often on, we adjusted the market. So when he started doing this in the 50s and 60s, there were still a few of those working capital stocks left, right? So it's, cash minus total liabilities. There's more money there than the stock's trading for. Those are just kind of gimmies. That's what Graham did. Those kind of began to disappear, and they've really all disappeared today. And then these discounts to books started disappearing. So as he went on, he went from paying half book value to 70% to 90% to maybe up to 120, 125% when he was ending his career. And Scott's asking, can I clarify how I compiled this information? Yeah, the information was compiled between every interview he's ever done and also his holding report. So he did several interviews. If you go through Google and just do a search for him, you can find some old stuff where he laid this stuff out fairly clearly, and also some memos from his desk where he outlined this stuff. But yeah, it's all coming from him. He didn't, yeah. He did adamantly say we never pay 2 times books. Like, we won't pay double book. So, I mean, when he says he focuses on book value, I mean, even if it's Google, he's not paying more than 1.25 times book. Often sought unloved areas of the market. And this is something, it's tough for us because today we're very, between CNBC and the Journal and everything else, we're pushed to be short-term focused. What Wall Street wants us to be. They want us to dump our ideas and buy new ones and trade and trade and trade and trade. But, in the cycles of the market, there are loved areas and there are unloved areas, right? So the unloved areas of 2013 were some of the computer companies in tech, like Intel company. Microsoft at one point last year traded at 11 or 12 times earnings. IBM's very, very lowly valued. So, some of these areas have been unloved for the last couple of years, and the more loved areas the last 12 months or so. Solar got a lot of push late 2013. 3D printing got a big push. Social media is very loved right now. So he would really focus on the unloved areas, and it's not as hard to find as you think. Just start doing scans when you see, a bunch of low PE stocks or a bunch of low price to book stocks in a certain area that seem to be lagging the market. That's really the unloved area. He did not buy financials, and most value guys don't. This is not uncommon. They just don't touch financials. He thought, the balance sheets were too hard to read. It was too complex, and he just stayed away from it. And he didn't buy tobacco stocks, and that was really an ethical reason. So if the ethical side of tobacco doesn't bother you, you can kind of ignore that. Now, when he bought, he always averaged in, okay? So if he was looking to take, a $50,000 position in a stock, he never went and bought 50K of the stock. He always started with about half or less of the position and then averaged in. Because as value guys, especially when you're buying an unloved sector of the market, when you're buying stock that is plummeting, coming down and down to value, you want to be able to buy more and buy more and buy more. And he did the same thing on the way out. So, when he sold stocks, he averaged his way out there as well. So he didn't just get it all at one fill price in and out. He was ready and willing to buy more stock if shares continued lower and sometimes even if it continued higher. One of his quotes, he said, "You really don't know a stock until you own it." And this is actually really true. And he would often take really, really tiny positions in a stock he was watching. So imagine, he's managing, $40 million, not a great deal of money, right? So 1% of that he's going to put in each stock is maybe $400,000 for, rough average of each of the stocks. Well, he may see something he's kind of watching, get a feel for it, and put, 30 or 40 grand into it. And he'd say you just don't know a stock until you own it. Then once you own it, it becomes much more personal, and you begin to watch it from a different perspective. And so that's another reason he would kind of average in. And once again, up to 10% in any one position. He looked for prices near 3-year lows. Okay, so one of the things he said is, when he's finding stocks trading at a discount to book, thinks this is a good value, and the stock's trading at $50, he'd look at a chart of the stock over the last 3 to 5 years and say, yeah, it's at 50 now, but it was at 25 just 2 years ago. So that kind of shows me this stock has further to go. So I don't want to call it technical analysis, but he would just kind of look at the historical price range to see where the bottom has been the last several years, and he wanted to buy in that level. And finally, he never discloses holding to the limited partners. Okay, so the way a limited partnership works is there's a senior partner that has control over the partnership, and then there are other limited partners, in this case is investors. There were like 19 or 20 of them that put money in. They're partners in this thing. They never knew what they owned. he would never tell them for 45 years. I mean, in his annual letters, he would mention a couple of highlights of stocks he bought, but said, look, if I start disclosing this stuff, then other people can essentially copy my holdings without being invested in the fund. You're getting free advice from me. And on the other hand, he said, yeah, the stock's trading lower now, but I'm willing to. I want it to. It's at 5. I want to buy more at 4 or 3. If I tell everybody about it, they're going to go buy it and bid the price up, and I won't get in there. So he just never discloses holdings, which I thought was kind of interesting, even to guys that have been investing with him for 4 decades. Now, finally, I want to show you this memo, and this is, I retyped this. This is was a photograph from a memo that came off of Schloss's desk that he wrote, and it's 16 factors needed to make money in the stock market. We'll kind of go through these. Some of them are very basic, and then we'll go to the GuruFocus screener and start looking for the type of companies that Schloss would buy. So it's right off his desk, typed by him on a typewriter. Number 1, price is the most important factor to use in relation to value. And we, of all people, should know that. 2, try to establish the value of the company. Remember that a share of stock represents a part of a business and is not just a piece of paper. Number 3, use book value as a starting point to try and establish the value of an enterprise. Be sure that debt does not equal 100% of the equity, capital and surplus for the common stock. So right here, big warning he's giving, and this is kind of a memo he wrote just to sort of beginner investors and some friends he was sharing with, but any balance sheet disciple is going to hate debt, and he was another one of those guys. If he says be sure debt does not equal 100% of equity, he's looking for debt to equity ratios less than 0.5, preferably less than 0.4, 0.3. 4, have patience. Stocks don't go up immediately, something we all need reminded of. Number 5, don't buy on tips for a quick move. Let the professionals do that if they can. Don't sell on bad news. So don't buy on good, don't sell on bad. Number 6, don't be afraid to be a loner, but be sure that you are correct in your judgment. You can't be 100% certain, but try to look for weaknesses in your thinking. Buy on a scale and sell on a scale up. So again, encouraging that same mentality of scaling your way into a position and scaling your way out, so you don't just have one chance to get in and one chance to get out, and you're kicking yourself if you got the wrong price. Number 7, have the courage of your convictions once you've made a decision. Number 8, have a philosophy of investment and try to follow it. The above is a way that I've found successful. So really open here, saying, look, if you're an earnings guy, you want to trade on something else, that's fine. But stick to your philosophy. If you're going to buy cheap stocks based on book, buy cheap stocks based on book. And don't get carried away and try to catch a penny stock, the next 3D printing runner, the next hot item. That's something he did. Number 9, don't be in too much of a hurry to sell. If the stock reaches a price that you think is a fair one, then you can sell, but often because the stock goes up, say, 50%, people say sell it and button up your profit. Before selling, try to reevaluate the company and see what the stock sells in relation to its book value. Be aware of the level of the stock market. Are yields low and PE ratios high? If the stock market is historically high, are people very optimistic, etc.? So what he's saying here is, if I think a stock's worth $10, I buy it at 5, and it goes up to 10. Don't necessarily just dump it. Take a look at the market. If you did that today, you'd see, well, PEs are historically a bit high, yields are relatively low. We're in kind of overvalued territory compared to historical levels. So yeah, I'd probably sell it. But if one of your stocks happened to reach its value in, say, 2010, and the PE of the market is 12 or 13 compared to average of 17 or 18, maybe you hold it and let the momentum of the market take it a little bit further. 10, when buying a stock, I find it helpful to buy near the low of the past few years. A stock may go as high as 125, then decline to 60, and you think it's attractive. 3 years before, the stock sold at 20, which shows that there's some vulnerability in it. So that's what we were talking about earlier, just looking for, where that shelf is, where buyers have recently found a bottom in this stock, and he wants to try to get as close to that as he can. 11, try to buy assets at a discount than to buy earnings. Earnings can change dramatically in a short time. Usually assets change slowly. One has to know much more about a company if one buys earnings. So some of this looks jumbled up. I typed it like letter for letter, so Schloss, maybe was an English major, but yeah, so he's just reinforcing the point, right? He buys assets. He doesn't try to buy earnings. There's money to be made in earnings, but he can't predict it. It's $5 a share one quarter. It's $1 a share the next. Assets, on the other hand, the value of the buildings and the holdings and the inventories they have are not going to change that dramatically quarter to quarter. 12. Listen to suggestions from people you respect. This doesn't mean you have to accept them. Remember, it's your money, and generally it is harder to keep money than to make it. Once you lose a lot of money, it's hard to make it back. So, another theme we see with a lot of these great value investors, they focus on protection of that capital. Because, we all know the rule. If you lose 50% of your money, then you've got to make 100% just to get back to where you are. So it's always better to leave a little off the upside than to take a little more on the downside. 13. Try not to let your emotions affect your judgment. Fear and greed are probably the worst emotions to have in connection with the purchase and sale of stocks, and we all know these to be large factors that move the market. 14. Remember the word compounding. For example, if you can make 12% a year and reinvest the money back, you'll double your money in 6 years, tax excluded. Remember the rule of 72. And the rule of 72, for all of you who don't know, whatever percent you can yield, divide that by 72, and that's the number of years it takes for your money to double. So if you're earning 10% a year, your money should double in just about every 7.2 years. If you're earning 20% a year, you can double your money every 3.5 years. 15. Prefer stocks over bonds. Bonds will limit your gains, and inflation will reduce your purchasing power. And finally, be careful of leverage. It can go against you. So these are the 16 rules of Schloss as typed up per him. I just wanted to share that with you guys because it's one of the few things that is really off his desk from his typewriter that I thought we could take a look at to kind of get inside his mind really quickly. So let's go ahead and go to our screener, and we'll start looking at how we can pull these types of stocks and how we can try to emulate what Schloss has done. So, we've got probably the best fundamental stock screener available online here, the all-in-one screener with GuruFocus. If you're not a premium member, I don't think you can use it, but you can always sign up for a 7-day trial, get full access. Give it a go. You're free to cancel anytime inside that 7 days if you want to try it out. But if you're not, I'll be glad to show you how it works, and you can kind of get a feel for it. If you are, then you've probably played with this a lot yourself. Really quickly, how many of you guys? Let me ask really quickly. Quick poll. How many of you are premium members? So just answer yes or no. Yes, I'm a premium member, or no, meaning you're either a basic member or you haven't registered. And either way, it's fine. You're both welcome to the webinar. I'm just trying to get a feel for where everyone's at and how comfortable each of you are with this website. Premium. Okay, Matt, Bo, Richard, Daniel. All right, thank you guys for answering that. I'll go ahead and close that poll, get it out of your way. Okay, so let's look at the screener. Now, based on what we've talked about, let's look at a way to screen for some of these. And I've got a slide here. I should have left it up. Here we go. So, I don't know why that's doing that. So here's the all-in-one screener as I run it to kind of replicate Schloss. All right, we're removing financials. We know that he didn't like financial stocks. I didn't invest in them, so go ahead and remove those. I remove REITs as well. It's kind of financial. The other end of it is there's a lot of real estate value. That's the whole balance sheet. We've seen what could happen to real estate as we saw in 08 and 09. On top of that, I just don't know how much I can trust the real estate holdings of a professional company, so I just removed those from it. Now, for market cap, I did 50 million or more, and you guys should be seeing this on the screen. For market cap, I'm looking at 50 million or more, greater than 50 million. And this is an optional one. If you want to get into the really small penny stocks and stuff, you can. I just prefer to keep it. I mean, this is still a micro cap company, but I try to get it just a little bit over, the $3 million companies and things that may or may not be real. Debt to equity, talked about, wanting debt to be less than capital, less than equity. So I've got that at less than 0.4 to try to find low debt. We're obviously going to give favor to the companies that have the lowest amount of debt. This is just a way to kind of filter a lot of those out. I go ahead and exclude over-the-counter stocks. The filing requirements are really loose for these guys. A lot of the data is incomplete. It's just kind of a headache. And that's all in the fundamentals. So on the valuation tab, I scan for price to book less than 1.2. It's kind of the highest end I want to go. I mean, you can scan starting at 0.8 or 0.7 or however low you want to go. But I try to give myself, when I'm done with it, I want to have a list of 30 or 40 stocks I can kind of dig through. So if you want to, you can filter it tighter, but in today's market, you're going to get less and less stocks. And we'll go through that. Profitability tab, I just set the net margin to greater than 0 because all this means to me is the company's not losing money. Right, your net profit margin, as long as it's 0 or greater, you're not just hemorrhaging cash. And then the historical valuation tab, remember we talked about trying to find stocks near their 3-year low. I put max percentage above that 3-year low at 35%. And none of this is in stone. You can change it. You can make this 1.0. You can make this 50% or 20%. Whatever. But this. I hope I just want you to agree. This is kind of the summation of Schloss's starting point. Now, he didn't have screeners. He didn't have computers. He went one by one through the value line sheets to try to find stocks trading at a discount. Tristan, aren't free cash flow better measured than earnings? I mean, yeah, we're not looking at earnings though. We're just looking at. I mean, I'm just using that to try to remove stocks that are hemorrhaging great amounts of money. Scott asks, if you get a list of 30 to 40 stocks running the screen, do you find this list turning over every couple months in order to build up a portfolio similar to the size of Schloss's? Good question, Scott. And I don't know how fast it's turning over in today's market. I mean, I will say, today you're going to find a lot less of these stocks than you could have found probably at any time in the last 100 years, just because of the level the overall market is at. So I think Schloss would have a hard time maintaining a 100-stock portfolio today. But as he mentioned several times, I mean, he adjusted with the market. So if I had to guess, if Schloss was still running money today, I would assume he'd be trying to buy companies at 1.2, 1.3 times book and just finding the lowest possible book valuations there are. I mean, he was always at least 90% invested. He never held much cash. So, he wasn't a guy that tried to time it very much. So he just got the lowest price to book companies he could. Tristan, you're looking at earnings. I mean, yes, Tristan, net margin is based off of the earnings figure, but there's not a free cash flow more. I mean, look, we can get technical with it. We really don't have to use that one if you don't want. I'm just trying to filter out some bad companies. So let's go to the screener and take a look at these. So really quickly, I'll go ahead and select all of our industries here. And then I'm going to take out financials. Notice we are at, how many records we're at? Let's see. Take out financial services. This is what's cool about this screen. You can just select them all and then pull out what you don't want or just search for various industries. Then I'm going to take out REITs as well. Okay, everything else I'll leave in. So every other industry is available. And then I'll go ahead and select USA as the country. And debt to equity, mentioned you don't want that any larger than about 40%. It's kind of the max threshold. So I'm going to go, these work on drop-down menus. The left side is minimum, right side's maximum. So we want it less than 0.4, so we're going to use that as our max. And you could also use interest coverage. Charlie did one of these where he ran interest coverage minimum of 10s, meaning they can make their interest payments at least 10 times over. It's another way to filter it down. There's no really perfect way. I mean, you're going to have to look at each of these stocks individually as you go through it. Then we're going to exclude over-the-counter stocks. And then here on the market cap side, again, I'm just going to do over 50 million. It's still pretty small companies, but when you get into those $6 or $7 million market caps, I mean, they're so tiny, they fall off the radar and fall off listing all the time. And I think that's everything for the fundamental tab. Let's go over to the valuation ratio tab. And again, the only thing I'm really going to do here is put price to book below 1.2. And see, we're already down to 156 stocks just in that one very filter. So we were, a couple thousand down to 150 just finding low book values. And you can play with different things. I mean, if you want to use price to tangible book, you can do that. Price to net cash. There's different ways to do it, but this is an easy way. And then net margin, again, I'm just looking at some kind of positive margin here. So try to filter this down to get rid of the ones that are just hemorrhaging cash. And then historical valuation, this is where we're looking at the price being a certain percentage above the 3-year low. So, I choose about 35%. You can go larger, smaller, depending on how small your list gets. It gets us about 24 stocks, which isn't bad. If you want a few more, I mean, we're all-time high level. You're not going to find a whole lot of stocks trading near that low. So if you want to go to 50% or so, you can. Give it about 35. And I think that's everything. That's all of our filters, all we really need to do. Was there one more? Okay, I think that should be all of them. Now, I got a couple of questions here asking about the data, if we'd speak to the quality of the data. So all of the data does come direct from Morningstar, and all the calculations are done on the GuruFocus servers. But it's the data is sent direct from Morningstar. It's about as high quality data as you can get, and as soon as it's made public and on Morningstar servers, there's less than a 20-minute lag from the time it gets to you guys. And as far as the 10 to 15 year track records, I mean, yeah, those are all 13F filings from the gurus. That is public information there on the Morningstar, from the Morningstar data pipe. And Saul, there is a way to screen for buybacks on the screen. This is obviously not one of Schloss's fundamentals, but right here on the fundamental tab, you see it's got share buyback rate. And you can do 10-year, 5-year, 3-year, or 1-year. So if you're looking for those kind of cannibal stocks that are buying back shares each and every year on a fairly consistent basis, you can set these to find that. So we're down to a list of about 24 stocks. Okay, so from here, really all you want to do is kind of dig into each of these and take a look at their financials. Just look at the balance sheet. Does it look healthy? And then make sure they're not just dumping cash over the edge of the boat, right? You know what I mean? If you're buying the book at a 20% discount, it's not very good if they're losing half their book value every year because they're blowing money out the door, right? So, we'll look at a couple of these. And I actually built a screener, or I've built a portfolio and just put some in here as I've been finding them the last couple of days to give you an idea. There's about 10 of them here from that screener that I've gone through. So we'll look at a couple of these and kind of show you what I'm talking about. Jeff, yeah, Schloss obviously preferred a dividend, but a lot of these stocks he was getting, there just weren't much of a dividend there. He was really after the price appreciation. He was really looking for the realization of value. There's a company called Eastern Company, okay, a one-star company. Not, these are not going to be super high-quality stocks. They're just going to be cheap. But look at how relatively cheap compared to some of these valuation numbers. We've got a market cap of $100 million, trading it right at our limit of 1.2 times book and 14 times earnings. So it's kind of how I run through them, just to give you an idea. The biggest things when you're looking for assets, when you're investing based on balance sheet, the most important thing here on this front screen is financial strength. Okay, and Charlie's got some great formulas here where it puts in cash to debt, equity to asset, Altman Z-score, M-score, F-score, and it compares them versus the industry they're in and also the history of that company, and you get a final score out of 10. If I look here and see 7 or higher on the financial strength, I'm going to keep looking. All right, if it's like a 3 or a 4, most of the time I'll just keep rolling on by. Now, Kai, as far as the Z-score, it's the Altman Z-score. You can click each one of these things, and it will give you a definition of how it's calculated and what it is. And as far as the stars, Norman, these stars are it's a GuruFocus proprietary feature and is the business predictability rank. So what it does is scan the last 10 years of EBITDA, revenue, and earnings of that company and looks to see how consistently the company is growing it and how predictable it is. So, if it's a company that 1 year at $2 a share in EBITDA and $3 and lost money, then made good money. This is like a one-star company. If you look at like a Procter and Gamble or something, you'll see, or a Walgreens, you'll see it more like this, and it's very consistent and very predictable, and not as risky. So okay, so we see, it looks fairly healthy based on the scan here. What do they do? Um, Manufacturer of industrial hardware, security products, metal castings. Again, Schloss really he'd openly say, I don't really care what the company's doing. I mean, unless they're killing babies or doing something awful. I mean, really wasn't too concerned with it. So we go here direct to the 10-year financials. First thing we're gonna do is look at the balance sheet, and keep in your head the market cap of this company, because it's much easier instead of looking, okay, it's $16 a share, let's see what's their earnings per share, what's their book per share. Just imagine you're buying the whole company, because the share breakdown is going to work out the same, right? So just look at the market cap, in our case 100 million, and we scroll down here to the balance sheet, and we see they've got equity of $80 million, or a book value of $80 million. So it's right about 1.2 times as we saw. Obviously, cash is the number one thing you're looking for. Cash is king. The more of it they have, the better. The more that book value made of cash, because you can't manipulate cash. They got 20. Here's the latest quarter: 20 million in cash, accounts receivable. We've got some inventories, mostly finished goods, raw materials. 70 million in total assets, and they've got building, machinery, construction. One of the things I like to look at is how much is it depreciated. Okay, so right here you're going to see gross property, plant, and equipment. This line here. You're going to see accumulated depreciation of that PP&E. And that gives you, the net number here. So when a lot of this has been depreciated, generally it's not marked up that much, right? If the original carrying cost was 62 million, they've already written more than half that down. That's not a terribly inflated figure, probably, right? But if there wasn't much depreciation in it, we know that's coming. It's going to continue to degrade the book value. So, a little bit there. Biggest thing to look out for: intangible assets, right? If this makes up the majority of that book, I'll generally steer away from it unless it's a special situation. If it's a large acquisition that just took place, and I think it's valuable one. But for the most part, intangible assets are things you cannot touch and see, so they often can't be sold, and you just kind of want to write that off if that is the case with it. So we're seeing decent quality of assets, right? A quarter of it is in cash, which is great. 20% of it or so is accounts receivables. They'll probably get their inventories. They're like a steel and casting. So these raw materials, works in progress, probably full valued, right? Steel and the like is not going to depreciate that much. And then finished goods. In a company like this, it's not a technology company. It's not Dell or IBM, where their merchandise loses 10% of its value every quarter or every month. These are probably pretty decent values that they're working with here. And if you want to get really in depth, you can read the company's financials, read their annual report, and see how they're valuing their inventories. So, assets look fairly decent. And what do their liabilities look like, right? This is what sends companies into bankruptcy. This is where all your danger is right here in the liabilities section. That's all the danger. All right. If a company has no liabilities, they cannot go bankrupt if you don't owe anyone money. So accounts payable is fairly small, about half of what accounts receivable was. That'll be cash inflow. Very light on the current liabilities, which is good. So current ratio is positive. Long-term debt, only $4 million. So for a $100 million company, they've only got $4 million in long-term debt. I would say that's fairly attractive. Very little debt compared to the company. Now, they do have pension and retirement benefits that they owe out. It's another $13 million for a total liability of $32 million. So not a great deal of debt here. And you can see the interest payments on this debt on the cash flow statement. If you roll down here and look at, where is it? Oh, sorry, it might be on the income statement. I'm losing my mind. Interest expense up here on the income statement. Boom. This is how much money they spend each year paying interest on their debts. This is very tiny. 200,000, 400,000, 300,000, very little money for a $100 million company. What's scary is when you see a company that's $100 million and that this is like a 10 or a 20. So a large portion of their operating income goes out to pay debt. So, here they've got EBITDA of, 17 million, 14 million, right around there. This is very small in relation to that. But if this were 6 or 7 or 8 or 10 million dollars, that's the majority of what they're bringing in the door. And what that says to me is, man, as soon as their sales figures shrink, they're screwed because they can't cover the debts. Just like in your personal life, you had a big fat mortgage you probably shouldn't have got. You're driving a brand new 750 BMW, and you've got everything, credit cards maxed out. If your salary falls a little bit, you're going to be in some trouble. It's the same way with these companies. So overall, balance sheet looks pretty healthy to me, right? And it's kind of an added kicker for this company. They make money every year. It's not a great deal of money, but they make a little bit of money. Between 5 and 7. We got 5.5, 8, $7 million a year. So it's about a 7% earnings yield. They're doing, $7 million, $100 million company. We got a pretty reasonable PE, especially by today's standards, about 14. They're trading just over book. They're not over leveraged with debt. They appear to be pretty good value. And then the final thing we want to check is, so it seems to be a reasonably cheap stock, at least in relation to what we have today. Now, a really cheap stock, which Schloss was able to find in the 80s, would be all the same stuff we just looked at. Okay, it's worth 80 million. It's pretty clean, not a lot of debt. But the market cap would be like $40 million. All right. So if we looked at all those other numbers, we figured, it's probably worth about 80 million cut up right now without ever making another dollar. They're pretty consistent. They haven't lost money. We see, they have positive net income each year, so we're not worried about degrading that book value. And then we can buy it at a discount. That's a Schloss stock. Now in 2014, with the S&P at all-time highs and Wall Street going nuts, they're a little harder to find, but this is still a pretty cheap stock based on today's standards. Now the final thing, look at the stock price. You can do that up here in the top right, and you can just go to 5-year, kind of see where we are in relation. If you want to see it in more detail, I click on the interactive chart. If you guys haven't played with this thing is freaking amazing, the interactive chart feature here. We'll click on the interactive chart, and by default, it'll just show you the price data over the last, in this case, 25 years or so. So we can look at the last 5 years, get an idea where the price has been. We're pretty near these lows, right? I mean, we're near 2009 lows at 12 bucks. That I would say March 2009 is a pretty good bottom for a stock, right? And that was about 11 bucks, 12 bucks. They've been as high as 25. So we're definitely on the lower end of that spectrum. And you don't want to get too scientific with this. Just say, all right, well, here's their high the last several years. Here's the low the last 5 years. And he really only looked at 3 years. So let me adjust that to 3 to give you an even better picture. There's 3 years. Say, here's the high. Here's the low. We want to be kind of down in this area, right? That bottom third. And we definitely are that. I mean, we're very much near this 3-year low. So, for me, EML looks like a pretty good Schloss stock to me. Okay, near these lows, mostly protected by book, consistent earner, not hemorrhaging cash, not issuing new shares. Eastern Company, EML, be a good Schloss stock. So I see we got some questions here. Let me answer these before we go on to the next one. Saul, where do you get industry metrics from, e.g., as far as the PE versus the industry? All comes from the Morningstar data. Yeah, all comes from the Morningstar data, and then Charlie puts it all together and does the calculations inside the site. Jeff, Schloss talked about demonstrated earning power. Can you screen for positive earnings per share 9 of the last 10 years? I don't know that you can do that exactly, except using the predictability rankings. I mean, let me ask Charlie. Charlie, Jeff's asking. Never mind, he just went offline. All right. Norman, is there a way of getting more detail on what each company includes in intangible assets? Norman, there absolutely is. You're just not going to like the answer, but I'm going to tell it to you anyway, because most of you guys probably don't own 100 stocks, so you're willing to do a little bit of homework for what you own. Here's the magical link you're going to want to go to, and Norman, it's kind of a pain, but if you're into your investments, it won't be. Right here, SEC reports will take you to a direct link for the reports filed by this company. All right. So if we click on that, it'll take us to the Edgar. And what you want to find is the most recent 10K. 10K is the annual report, and the 10 quarter is the quarterly report. So whichever you want to look at. Look, we've got a 10K here. Just click on the document side and click on the full form 10K right here at the top. And here's the big bad boy. And when you've been through 5 or 10 of these, you don't have to read every single thing. We know it goes blah blah blah. They go through the risk factors, go through a lot of garbage. But when you scroll through, and you may want to read the whole thing for the first few, especially if you're really interested in the company. But you just kind of got to dig through here, find what they're talking about inventories or their balance sheet, and they will explain what those intangible assets are. So not a lot of fun. You really want to reserve that for, okay, this is definitely a stock I want to buy. As long as those intangibles are decent, then you can go in there. Norman, do you have a link to the CDAR too? I don't know if it automatically links in here if it's a CDAR instead of Edgar. I don't believe it does, but you can go to the CDAR system, which is Edgar's the U.S. the SEC system that keeps all those filings. SEDAR CDAR is the Canadian one, and they've got the same. It's a little bit tougher to work, but you essentially find your spot, put in your ticker symbol, and you can find the same thing. So that's Eastern Company. Any comments on the stock? You guys telling me no, you're full of crap? I mean, this is pretty much what the kind of stock Schloss is looking for. Does this all make sense to you guys? And it wasn't terribly hard, right? I mean, we barely know what this company does, but we know that for the last 10 years they haven't lost any money. The interactive chart's another cool thing you can do. So you can look at let's see, get on a balance sheet. And I'm looking for total equity. There it is. So we can plot the total equity of this company over the last, we'll say, 10 years. And we see here this company's got a nice history of growing that book value, right? There's a blip here in 08, which almost everyone had, but over the last 10 years, done a really nice job of growing that book value, from 40 million in 2005 to 81 million today. So even if we overpay a little bit, this is a company that should grow that figure, and this 80 should become 90, should become 100, 120, etc. So even if price doesn't catch up as fast, our investment should grow. Stephen, do you use a tangible book bar chart at the top of the page to quickly screen for Walter's method? Yeah, you can do that. Here's tangible book. What he's talking about is some of these valuation metrics that Charlie's put in here at the top will immediately tell you how the stock stands up based on these various valuation metrics. Like the Peter Lynch value exceeds the price it's at. The Graham number is right about at it. Median price to sales is right about at it. Projected free cash flow is actually a larger figure than it's trading. Basically, the more of these you see to the right of the dotted line, the better. It's trading a little bit. Tangible book is less than what it's trading at, and we saw that. But yeah, it's a nice quick way to scan for it, sure. Greg, would the interactive charts illustrate a question about earnings for the past 10 years? Yeah, I mean, there's not a way to scan for it, but if you want to look at earnings for the last 10 years, sure, you can just come in here to the income statement tab and look at, or you can just search. Let's see, EPS. There it is. Here's earnings per share the last 10 years. So you see, it's a little bit spotty, but it has been positive for all the last 10 years. This is the 0 mark down here, and you could even go back way back to 1995, and you see they've really never lost money in any one quarter, which is a great find. Did Schloss incorporate any sort of need search for a catalyst for value realization? Sounds like not, and it was more of a matter of finding a decently cheap company based on assets waiting it out. Yeah, Scott, I mean, you're exactly right. He from everything I've read from him that he wrote and interviews he did and everything he spoke and is letters to his limited partners, he really didn't go that in depth as far as trying to find a catalyst. I mean, he would just look at, look, this is an area of the market that's cheap right now, and over the next 4 years, I expect it to come back, right? And so he didn't have some of the complications we've got as far as social media and 3D printing and these new things that we're not sure if they're going to take off or not. But, if you look at the auto industry or, the steel industry or like mining's pretty cheap right now, microprocessor companies, utilities, those type of large categories that have been around for 50 years, or well, maybe not microprocessors, but most of them have been around for decades and will continue to be. You just kind of find the areas that are underpriced relative to others, and he just sort of had a faith that that area will come back, and it's part of the cycle of the market. So some of these stocks he probably held for 7, 8, 10 years, not a lot of them, and some of them he got paid in 6 months. It just the average roll up here is about 4 months there. Fernando, in your screener for Walter Schloss stocks, the top guru held stocks are IBM and BVN. Can you review this finding in the new feature valuation map? Yeah, we can look at that. Wilson, how about normalized earnings you touched upon? So as far as normalized earnings, I don't think there's really a way to scan for those, but here's how he'd kind of look at normalized earnings. Yeah, okay. Charlie said one of the similar things would be like the Schiller PE ratio, but if you're looking at normalized earnings, here's how you can do that. You can either use the earnings per share up here or the net income figure. I like to value the whole company, so net income's easier. Again, all the calculations he did, you can do on a scratch piece of paper with third grade math. So this is kind of how he would average out earnings. Say, all right, well, last year they did 6.9, they did 8.6, 5.5, 5.5, and then a really bad year was 1. So if I add all those up, I get 11, 12, 20.6. 27.5 divided by 5 is what? About 5.5. So normalized earnings would be about $5.5 million. So normalized earnings is about 5.5, and you may not want to count. I mean, '09 is a pretty big anomaly. Without it, you're getting normalized earnings of about 7 million, 7.5 million. That's pretty much it. So we'd say, I'm not counting on this to grow, 8.20% or whatever it is. I'm not going to count the biggest year, but just on average, they're doing about 6-7 million bucks a year. So that's what I'm gonna base my valuations on. All right. So when it comes time to sell it, say this thing was at 50 million. Right, and the market cap's 100, or the book value is 80. Right, so say for instance, this stock really just got hammered. It's down to like $8, since this is like $50 million. So when the stock climbed and got to 15 or so, and it was at book value of $80 million, then you might come in and say, okay, I could sell it. It's reached a book, or what are their normalized earnings? Well, they say they're around $7 million. Okay. And the company is now an $80 million company. Well, the S&P, the PE ratio for the S&P average right now, say it's 18 or something like that. Meanwhile, the PE ratio for this stock, making 7 million over 80, is only about 11 or 12. I'll probably hold on to it. Let's see if we can catch up with the rest of the market. And that's really as complex as you've got to get with it. Boyd, good question. What was his sell discipline if he was wrong about a stock? Did he ever hang on forever? What would force him to sell at a loss? So he, like most guys, were pretty stubborn with their picks. The only time he sold it is if values change. So the reason he favors book value and asset values of earnings is that they change much slower. But a good example of this would be like Blackberry, right? Now, Blackberry was a stock that I bought back in 12. It went to $7. I figured it's worth 14. Got up to 14. I sold it. It was easy money. But then it's been beaten up, much severely, far more severely since then. So here's what happened. When we look at the balance sheet, this will be a good kind of case study for us. Let's see if I can find. Here we are. So as of Feb 13, they had book value. And it's depreciated. I mean, it was at like 10 billion, then it was about 9.5 billion, and then all of a sudden it's at 3.5 billion. Now, how do you lose $6 billion, excuse me, in 1 year? Well, didn't spend much of their cash. Accounts receivable shrank. They sold off some land and facilities. The machinery equipment, they wrote that down dramatically. They took $1 billion write-down on those BlackBerry 10 phones. They wrote that out of their intangible assets, you see here, from 3.4 to 1.4 to $2 billion disappeared like that. And it's just, it's broken down. Like, I mean, it's done a horrible thing by blowing through money when they weren't profitable. They should have, leaned down their workforce and leaned down their production long before, but they didn't. So if you get a situation like this where, for what I'm not saying to take it book value just at what they stated, but say you figured the company's worth, $6 billion back here. And all of a sudden they got huge write-downs, they got massive losses, they're just hemorrhaging cash. Then you look and say, oh man, I own this thing, at a price at a stock price equivalent to maybe, $5 billion, including not even worth that. The fundamentals have changed. I'm going to get out. Okay, so that's generally the only times you get out of it. And you try to avoid those situations by buying companies like the one we just looked at that have consistently profitable revenues. They're not an exotic. They're not in a very rapidly changing industry where you go from being the leader to being a joke in a 2-year period, like happened to Blackberry. Just go for the more, your steel businesses and the concrete and shipping and mining. These companies that don't fluctuate as much. So let's look at one more. Let's see. What did I put in this portfolio? I don't remember all the other ones. RELL. I don't remember what that was. Richardson Electronics. This is another small company you see, and most of these are going to be small caps and micro caps, guys. You're just not going to get. You're not going to buy Home Depot at less than book value for the most part. $150 million company. The P/E ratio is very high, but they're trading at a discount to books. We're going to take a look at it. Now, once again, the financial strength seems to be very much intact here, 9 out of 10. So very safe. The Altman Z-score, F-score, cash to debt, equity, interest coverage, all really, really strong compared to the history of the stock and to the industry in general. So really strong. I'm willing to dig deeper on this one. They are founded in 1947, incorporated in Delaware, engineered solutions, power grid, microwave tubes, and related components. Again, I don't really know what that is. I don't know much about it. I'll dig into it later if I decide I want to invest. But for now, let's just take a look at the numbers. So again, the one you want to keep in mind, what's the market cap? What are you basing your valuation on? So stick that $147 million in your head and just hold on to it as you scroll through here. First thing we see, big chunk of cash. This is great. This is a good sign. All right, the bigger this number is, the better. We got $97 million in cash compared to a $147 billion market cap. So for every share of stock you buy, 2/3 of it is sitting on the books in cash. Another $33 million in marketable securities. Cash and equivalents, which is just cash, CDs, stocks they can convert to cash, $130 million in a $150 million company. So really, really strong. Okay, $130 million. Let's go through the rest of this. A little bit of accounts receivable should be fine. They always hold about the same level. $35 million in inventories, about the same they've been holding the last couple of years. Total current assets, $205 million. Now, as we scroll through the longer-term assets, not holding any land, no buildings, no machinery, none of this stuff. Just a little bit of PP&E. $2 million intangibles, around $205 million. So I mean, even if I cut some discounts out of this, I think they're good for every bit of what, probably $185 million or so, right? Easily. I mean, you can trim inventories a bit to be safe. You can trim these little tiny intangibles out, but I mean, for the most part, this is probably every bit of $200 million, right? So let's look at what they owe to offset that. They have 0 long-term debt, which is fantastic. A little bit of deferred tax revenue, some other long-term liabilities, accounts payable like they hold every single year, actually lower than usual. So pretty low. I mean, again, they're never going to understate or overstate their liabilities. You can always take that number as is. So 26 is what their number is. So, you take 205 minus 26, you get about 180 or so. Listed here at 178. I mean, I'd pretty much give them every bit of that. I mean, max haircut, I'm looking at valuing this thing on book at 165, 170 million. Meanwhile, we're able to buy it today at 147. Okay, so it's trading at a discount to book. All the book looks legitimate. It's not made up of intangibles. It's not made up of a bunch of inventories that are going to depreciate quarter over quarter. Now let's see what they're doing. Let's see what they're doing with the money. It's always the scary part. And it doesn't look that bad. Okay, now what's happened to this company? Well, sales have been absolutely hacksawed in half if not more, since 2009. They're doing 500, 500, 550, 500, and then boom, down to like 135 million. But the cool thing here is, even though their sales shrank way down, their net income has stayed positive. So it's a lean company, right? They're able to shrink this SG&A, selling, general, administrative. That's just what it costs for office phones and secretarial salaries and office salaries and copy makers. All the business expenses. They shrank them when sales shrank, and so they can maintain. They're nimble, right? They don't have these huge fixed costs. So the last 4 years have actually been profitable, really profitable in 11. I mean, take a free look at free cash flow. We know it's a little bit of a cleaner picture as far as earnings go, and we see free cash flow. It's not wonderful, but there's really nothing scary about it. I mean, even back 2009, they were cash flow positive. They had an ugly year in 2012. Maybe something you want to dig into a bit to see where this came from. Look like a working capital change and a big change in payables here. So that's probably responsible for the majority of this. Put $423 million into investments. That's probably a big part of it too. But anyway, not bad looking, right? We're not going to buy this company to be an earner. They're not really predictable. We're not expecting, we don't know if there's going to be huge growth out of it. It doesn't look like they're growing, but they're maintaining. They're not losing money. They're actually profitable, and we're getting them at a discount to book. So, if we're figuring this company is worth, what do we say, 175, call it 170 million. If we think they're worth 170 million, and it's being offered to us at 147, we're getting it at a small discount of around $23 million. And 23 out of 147 is what? Around 6, around a sixth. So, we're looking to get maybe 15% or so on this stock to reach book value, right? So not a huge discount. We'd like it to be deeper. But given what's out there, really not too terribly bad. I mean, it's a discount to book. When that 15% becomes 40 and 50%, you've got really great opportunities. Let's look at the interactive chart to see what price has been, make sure we're within that kind of 3-year low range. Now, we're actually a bit high here. Well, not on okay, so the 3-year range are actually on the low end. We're good there. The last 3 years is traded between around 15 and just over 10, and we're at 10.5. So we're definitely buying on the low side of the 3-year range. If you really want to find a bottom and go to the 5-year, back to the 2009 crisis to see how low it can go, it got pretty ugly, down to about $3 a share. But over the last 3 years, on the low end, and to be on the low end of a 3-year bull market is actually pretty strong. So, I'm going to do a little bit more research, right? I mean, one of the things I do when I'm trying to figure out what's going on with the company, I just go to Yahoo Finance, and they've got a really good filter here. Now, their financial stuff doesn't hold a candle to what GuruFocus has. But if you're just looking for like, what happened to the stock, any recent news on it, it'll list it out right here. So if there's anything massively going on, their little spiders will find the article, and you'll see it right in here. John, yes, the historical price charts do take into account stock splits. Absolutely. So there's another one that could be a possibility. Richardson Electronics, RELL. Keep that on your watch list. Again, trading at a pretty high multiple to earnings. But the reason is you're getting, essentially if you shut the business down tomorrow, fired everyone, sold everything off, hopefully you could turn a profit with it. You could Gordon Gekko it, if you will, if you needed to. Praveen, yeah, these would definitely be called cigar butts, Praveen. This is definitely the definition of cigar butt investing. It's a stock that you think's worth 14. You're getting it at 10. You're going to buy it, flip it out when it gets there. It's not, this is like 1955 Buffett stuff. It's not 2014 Buffett who's looking for the greatest businesses in all the world and he wants to hold them forever and ever and ever. This is definitely cigar butt investing. Absolutely. Well, we're just about at the end of our hour. Let me turn it over to Charlie Tiana. He is the architect of GuruFocus.com, the creator, founder, CEO, programmer, and actually answers some of your support emails. So if you get one from Charlie, that's the boss man you're talking to. I'll give you guys a couple of minutes to ask questions to him. If you have some of the more technical questions you guys were answering, he will be able best to tell you. And then we'll wrap up our Schloss presentation.
Hello everyone, this is Charlie Tian. Thank you very much for attending our webinar. And Ross has been doing a very good job on this. I'll be glad to answer some of your questions. Uh, John's asking, did Irving Carr follow the exact same procedure? I would think so. Irving Carr is looking for very cheap companies too. He was a student of Ben Graham together with Walter Schloss. Uh, do we have Guru training problem in premium service? No, we don't. We do have lots of interviews with the gurus, and we'll continue to do webinars. And he is suggesting we need a normalized earnings for the last 10-year option. But to me, the Shiller PE, the Shiller's earnings will be inflation adjusted earnings will be very close to normalized earnings. So if you want to look at the ratio of price over normalized earnings, you can look at the Shiller PE. I think it's even better than the direct average. And the all our screener Wilson is asking whether the about Asian countries. Yes, all our screeners and charting tools and the financial data will work well for Asian countries. They work in a similar way. Uh, yes, you can see Schiller P on GuruFocus. You can see it on the 10-year financial page. For instance, I can show you here. Uh, Go to the 10-year financial page, and at the bottom of the valuation chart, valuation area, ratio area, the last one is Schiller PE. And you can also see the charts in Schiller PE charts in the interact chart, also in here. Uh, One thing Ross, we could do also after you create the Schloss screener, you can import all these stocks into a portfolio by clicking here and by clicking here, uh, yeah, and you can here after you generate this screener, you can add all this into a portfolio. Then you'll be able to monitor uh, the performance of this portfolio to see how it goes over time. Yes, you can. Previn is asking whether you can screen over Schiller P. P is less than Schiller P. No, we don't have that kind of screener, but you can screener for Schiller P less than certain value. Uh, you don't have to exclude OTC, but you can if you want. What is Mr. Schloss yearly turnover? What's his turnover? Yeah, his turnover is about 25%. Thanks. Yes, you can access all the Guru webinars for replay. There are all the past webinars are at home tutorials here. If you go to the home menu and the third one is tutorials. If you click here, all the past webinars are here archived here. Yes, Schiller P. Norman is asking. Schiller P is calculated for each individual stock. Yes, and it is a premium feature. You can also screen with Schiller P, just like regular P. Yes, there's a preset water Schloss screener here in our all-in-one screener, and you can access here. Go to the all-in-one screener, and there's a GuruFocus screens, and one of them is water Schloss screen here. We also write articles explaining how we set the parameters. Okay, very good. Okay, if there's no more questions, and I will give this back to. Do we know any guru who's presently using Schloss criteria? Mm, Not as we know for the gurus we cover. I think Michael Price will be very close to that, and he invests mostly in small cap companies. I think that's probably close. John is asking why some stocks show certain parameters like gram number or lunch number and others don't. It's because how the numbers are calculated. For instance, gram number it uses parameters book value and earnings. So then you take a square root of the product of them, and so it requires earnings to be positive. So if the earnings is not positive, you cannot calculate gram number. And similar issues with lunch value and others. Do we show guru strategy? We do show some of the strategies, and we explain how they invest the best we can in the profile in description of theirs. Yes, when you pick water Schloss preset screen, it may show this score. It's just one way we set it so that because this score is an indication of the financial strength of the company, so we set that way just to make sure that you are selecting from relatively strong companies. And you can use other parameters to achieve similar purpose. Yeah, this is our preset screens. And as I mentioned, yeah, Altman Z score was there to select strong companies only. Boyd asking whether we have a way to screen for non-gap earnings. Yeah, we actually recently just put into another PE. We call PE not without recurring items, without non-recurring items. We will release it. It's not released yet. Yes, Jack's asking whether webinar will be archived. Yes, webinar will be archived at explain here. It will be under home and the tutorials link. Yeah, for the next week we'll be hosting a Peter Lynch webinar. Correct. Okay, very good. Thank you all very much. I will get back to this too.
All right, thanks, Charlie. And yeah, you guys asked about the webinar. So next Monday we're gonna do how to pick stocks like Peter Lynch, and this is what well, I'll have it up in a minute. But when you guys when you go to the GuruFocus page, every night after the webinar, I update these. You see here in the top right where it shows you what next Monday's webinar is going to be. This is replicating Walter Schloss. In about an hour, it'll say how to pick stocks like Peter Lynch. Anytime you can click on this, and it'll take you to the registration page. Or if you want to come in, right at the time of the webinar, you can click it. It'll take you directly to that page. So definitely check us out next week. We're going to do how to invest like Peter Lynch. And Peter Lynch is a definite growth guy. So if you're more of a growth stock investor, check that out. I mean, most people try to balance their portfolio, right? You want a little bit of growth in there. You want some deep value like the Schloss style. You want some Buffett as far as, holding some Wells Fargo, some Coke, some really safe dividend money. Try to mix that up. So we try to cover all aspects of that. And Lynch was one of the few value growth guys who actually had some limits on what ridiculous prices he would pay. That's why he did so well. So we're going to cover that on Monday. Be sure to register for that. You'll probably get an email on Friday about it. But again, in about an hour, just come click this. You can register for that webinar. Be sure you get all the information on that. If you guys have any other suggestions, things you want covered in one of these weekly webinars, definitely feel free to let us know. You can email support@GuruFocus.com or ross@GuruFocus.com, and we'll be glad to try to accommodate you as best we can. We appreciate all of you coming to the webinar this evening, and hope you have a wonderful night, a good week in the markets, and we'll see you next Monday evening.